Right now, Rezolve AI, ticker RZLV, is trading live on the NASDAQ at $3.95. That is a sharp drop just in the first few minutes of trading, down about 11.8% for the day. Now that's the number. But what's fascinating, and what most people checking their Robinhood app this morning are probably missing, is why it's dropping. Because just 6 hours ago, Rezolve put out a press release talking up its position in what it calls Agentic Commerce, citing validation from Amazon's CEO about this being the future of e-commerce. You see that kind of headline, you expect the stock to fly. Instead, it's getting hammered. This isn't a glitch. It's a massive disconnect between the story the company is telling and the reality of what the market thinks that story is worth. This is the expectation versus reality gap that traps so many people in online investing. The expectation is that you found the next big AI play. The reality, when you look at RZLV, is far more complicated and frankly much riskier than the headlines suggest. Let's establish the common ground, the narrative that has drawn people to this stock. The general belief is that Rezolve AI is a new, fast-moving player in the artificial intelligence space, specifically for retail. We all see what's happened with NVIDIA stock over the past few years, and investors are desperate to find the next one. The story is that RZLV is pioneering Agentic Commerce. The idea is that autonomous AI agents will soon do our shopping for us. You tell your phone, find me the best deal on running shoes, size 10, blue, and order them, and the AI does the rest. Rezolve claims to be the platform to make that happen. They've even made a few acquisitions recently, a payments company called SmartPay and a blockchain data firm called Subsquid, to build what they call a 3-layer architecture for this new system. This has gotten some analysts excited, with a few firms raising their price targets. So the expectation is clear. You're looking at a small-cap stock with a massive addressable market, a first-mover advantage, and a story that sounds just like the disruptive tech that built giants like Apple stock. But then reality hits, and today's 11.8% drop is that reality making itself known. The first thing you have to understand is that RZLV isn't some hot 2024 startup. This company was founded in 2016, and it didn't go public through a traditional, rigorous IPO. It came to market in August 2024 through a SPAC, or a special acquisition company. For experienced investors, that's an immediate yellow flag. While some good companies have used SPACs, the pathway is often associated with businesses that needed a faster, less scrutinized route to the public markets, and their long-term performance history as a group is poor. This isn't a stock that a conservative manager at Fidelity Wealth Management would likely be adding to a portfolio. This is the deep end of the self-investing pool. The narrative is about the future, but the stock's structure is built on a financial vehicle that has burned many investors. Now, let's get into the fundamentals, because this is where the story completely falls apart. The expectation is a high-growth tech company. The reality is a balance sheet that is hemorrhaging. In their last reported quarter, Q2 2025, Rezolve posted total revenue of just $3.16 million. In that same period, their net loss was negative $28.93 million. Let me be clear, they lost more than 9 times what they brought in. Their net profit margin isn't just negative, it's a staggering negative 915%. This isn't a company that's just reinvesting for growth. This is a company that is burning cash at an unsustainable rate. Their cash from operations was a negative $9.9 million, and their total cash on hand was just $9.86 million. This means at its current burn rate, the company has a very short runway before it runs out of capital entirely. This isn't an investment. It's a speculation on survival. But it gets worse. The most alarming figure on their balance sheet is shareholder equity. it's negative $14.29 million. For anyone new to online investing, that means the company's total liabilities are greater than its total assets. The company is, from an accounting perspective, insolvent. This is a massive red flag. It signals that the business is in a precarious financial position, and it leads to the next logical and painful step: dilution. Because when a company with negative equity and a high cash burn rate needs to stay alive, it has only one real option: sell more stock. And that is exactly what Rezolve has been doing. Shareholders, according to recent reports, have been substantially diluted over the past year. We saw this in December 2024 when the company announced a $10 million public offering. They sold shares at $3 apiece. But they didn't just sell shares, they sold them with warrants. This is a key part of the reality that the Agentic Commerce story conveniently ignores. Those warrants, which are a right to buy more stock in the future, have an exercise price of $3. Think about what that does. It creates a massive overhang in the market. Anyone who got those warrants can now buy shares at $3. And with the stock having recently traded as high as $8.45, they can immediately sell them for a large profit. Today's 11.8% drop on good news makes perfect sense in this context. It's highly likely that as the company pushes its new PR campaign, insiders or warrant holders are using the resulting liquidity, the spike in trading volume, as their exit. They are selling into the hype. The new hopeful buyers coming in through their SoFi Invest accounts or Fidelity mobile app are providing the liquidity for the old, informed holders to get out. The 52-week range of $1.07 to $8.45 tells you everything. This is not a stable asset. This is a trader's play, and right now the trade is to sell the news. The average daily volume is over 22 million shares. This is a hot potato, and today people are dropping it. Let's briefly touch on the business model itself. The company is actually split. On one hand, they are pushing this Agentic Commerce idea, which is consumer-facing and futuristic. On the other hand, their own website and Microsoft's App Source list them as a B2B service desk for IT and HR departments, built to work inside Microsoft Teams. This is a very crowded and far less exciting space. This lack of focus is concerning. Are they a B2B service desk provider or the future of consumer AI shopping? Trying to be both often means you succeed at neither. Their three-layer system of SmartPay, SubSquid, and BrainPower sounds impressive, but it's all built on very recent acquisitions. The synergy is theoretical. They're trying to bolt pieces together to create a compelling story, but the financials show the core business, whatever it truly is failing. This isn't a finely tuned machine like you'd find at a company in the Fidelity ETFs or Fidelity mutual funds portfolios. It's a collection of parts that is costing a fortune to maintain. This brings us to the future outlook. The expectation is that this stock, if it can capture even a tiny fraction of the e-commerce market, will be a multi-bagger. The reality is that its primary risk is survival. The catalyst for this stock to go up would be a massive, named contract with a major retailer or a sudden, dramatic turn toward profitability. But the much higher probability is continued cash burn. This means they will almost certainly have to announce another public offering, selling more shares and further diluting anyone who buys in today. That negative shareholder equity is a shadow that will hang over this stock for a long time. And let's be honest about the competition. If Agentic Commerce is truly the future, who is most likely to win? A tiny, cash-burning post-SPAC company? Or the giants who already own the ecosystem, like Amazon, Google, and Apple? Rezolve is a minnow trying to compete with sharks, and it's bleeding. I want you all to think about this disconnect. Comment below. Do you think Agentic Commerce is a real investable trend, Or is it just the latest marketing buzzword to pump a stock? For an investor, the path here is fraught with danger. This is not a stock for an individual brokerage account that's meant for retirement. This is not something you add to your Schwab intelligent portfolios. This is a pure gamble. If you are going to trade it, you need a sophisticated platform, something like Interactive Brokers, where you can manage your risk with complex order types, because this stock can and will move violently. The average investor looking for investment help should stay far away. The risk of total loss is significant. While platforms like Robinhood have made stock trading accessible, they've also made it incredibly easy to get hurt by stocks just like RZLV, which are 90% story and 10% substance.